to thank you, Mark, for being here. To all the participants, a couple of housekeeping items. If you could, please mute your microphones, because sometimes we pick up some background noise, and that can be distracting to everybody else on the call. But our speaker today is Mark Dotzour, who is, I guess he's retired now from the Texas A&M Real Estate Center, which he ran the economics portion for 18 years. Before all you Longhorns start groaning, he's got a PhD in finance and economics from UT, so he's got everybody covered. But anyways, he's here to talk to us today about the economic outlook and give us great information for future investment decisions. Just so you know, we didn't get a hack. It's not that he just has a PhD. He's been quoted in the Wall Street Journal. He's given presentations to hedge funds, professional institutional investors. He's done it over 1,600 times. So that by now he's pretty good at it. The other thing I will vouch for is he has a gift for making something that sometimes can be dry, interesting, and at times entertaining and comical, which when things are tough, it softens the blow for all of us. At the end, Mark has graciously agreed to stay and answer some questions. So if you have questions along the way, feel free to enter them in the message box, but we'll try not to cut in partway through, and then at the end, Mark will address those. So with that, I'd like to turn it over to Mark, and hope you all enjoy the presentation.
Thanks, Michael. It's great to be with you all again. I understand this is the third time now that I've made a presentation to EO, and I just want to give a greeting to all of you businessmen and women that are sitting in today. And my goal is to not necessarily be a Zig Ziglar kind of power positive thinking, let's put some lipstick on a pig and sell something kind of speech. But what I have tried to do over my career is give people a toolbox of information to help them make good business decisions. I have such a strong confidence in the businessmen and women of our country that if they get the facts, they can figure out a way to make things work. And that's what I'm hoping to do today. And looking forward to this. The title actually, I want to say, is The Economic Outlook for Business Decision Makers. Last speech I made was on commercial real estate, and I made a mistake and didn't change the title. I changed several of the slides, but not the title. So this isn't a real estate deal. I know who I'm talking to, and I'm talking to businessmen and women trying to figure out how to make best business decisions they can make. So with that said, Jennifer, would you go to the next slide, please? I always pick a picture to try to summarize the U.S. economy in one picture. And for a month, from till the end of March and into April, I couldn't do a PowerPoint. I was doing fireside chats at the time because I simply didn't have data to explain anything. And I didn't really have a concept about how to present it. But I was looking, and all of a sudden I came across this photo, smoke coming out of a volcano. And I thought, this is so appropriate right now. It looks ominous, it is threatening, and it's something you can't see through and something you can't quite grab your hands and grab a hold of it. And we're still there. We're getting farther and farther away from the end of March. But just a few months ago, the medical system became under duress. And then what caught me off guard was our personal freedom came under duress. I wear a mask, by the way. I'm 66. I've had pneumonia 3 or 4 times, bronchitis almost every year, asthma. And so I'm wearing a mask and I'm staying at home. But I like the freedom to be able to do that. And I also recognize and value the freedom of a 15-year-old to go out and go to school or whatever, even go to a party. But by the same token, I feel like I have a personal obligation for me to wear a mask when I go out, not for me, but for other people. And so anyhow, the personal freedom, that was a game changer for all of us. And then the businesses started to struggle. And then the bond market collapsed. I didn't know this was happening until I was in it. I remember precisely March 17th and then March 18th, when I have a bad habit. I don't play too many video games, but I like to look at my stock account when I got nothing to do for 10 minutes. And I happened on the 17th to look and see that a whole bunch of bank preferred stocks that always traded about 24 to 26 were trading at $15 a share. And I'd never seen that in my life. Realized something was wrong. A couple of days later, the Fed comes out and says, that's okay, we're going to buy every bond you can imagine. That then sunk the stock market. And then our supply chain changed because of the lack of airplanes coming and going overseas and all the rest of the just-in-time manufacturing. And then the other ecosystem is state and local government. So this is a big deal. It's survivable, but it's not something to ignore and something to downplay. Next slide, please. There for a while, people were talking about, is this going to be a V-shaped recovery or a U or a Nike swoosh or a W, all that sort of thing? In my mind, that question is too broad and too general to have any meaning. And I'm going to get to that in a minute. It was clear to me from the beginning it was going to be a gradual recovery. And the big question in my mind is, how long will it be before Americans feel comfortable to go somewhere and do something again? And that's still kind of debatable. Another issue is, will we have another government shutdown? Will we have more virus this fall? Sounds like it's possible. I thought maybe I was stupid enough to think that the hot summer would be good. It's like, you don't have the flu season in July. Well, this obviously isn't flu season because we got it in July. So this question is kind of a moot point at this point. We never got rid of it in the first place. So yeah, probably going to have it for a while through and into next year. But here's the biggest question in my mind. Can the government force us to abandon our business again? And I personally believe that the odds of the likelihood of that happening are nearly zero. And I'll get into that in a minute. Next slide, please. This is becoming one of the biggest issues when it comes to businesses and investment. Force majeure, I don't know. I grew up in Kansas and have lived in Texas for a total of 30 years now. And we don't speak much French either here in College Station or in Wichita, Kansas. So forgive me if I mispronounce it, but force majeure, what that means is there's an unforeseeable circumstance that allows me to void my contract. I don't care what I promised you, I'm not doing it. And I first thought about this about oil and gas. And I thought all the contracts out there that people might say, you know what, I agreed to pay you $50 a barrel, but I'm not paying you $50 a barrel when it's $14. You can forget it. But what I never envisioned, because I'm only 66, I'm still a rookie, I never in my life have seen or even contemplated the idea that our government would come out and say, it's okay to stop making your mortgage payments. All you got to do is say that you've been impacted by COVID and you don't have to make your mortgage payment on your house for a year. Oh, and by the way, it's okay to just decide not to make your lease payments either. And so as we sit here today, the risk associated with business and investment in America has been altered in my mind somewhat permanently. Because think about it now, if you were going to, just to make a simple example, if you were going to invest in a mortgage a year ago, you would have assumed that, hey, those people are going to pay because they're supposed to. That's what the contract says. Well, when that all of a sudden the government comes out and says you don't have to make payments for a year, that changes the risk premium on all investments in my mind, whether it's owning an apartment building or an office building or a contract between a supplier and a business. Next slide, please. This was kind of an eye-opener to me. I don't know if y'all like music or not. I do. I'm so out of date, but the Talking Heads was a band that I used to love back in the late 80s, maybe the early 90s. And they had a song, the lyrics went, "This ain't no party, this ain't no disco, this ain't no fooling around." Well, when I saw this, I thought, this is SHRM. This is the Society of Human Resource Management. So it's not some kind of CNN or Fox News kind of organization that highlights and exaggerates everything. 52% of small businesses expect to be out of business within 6 months. This is something we all have to take pretty seriously, especially our government, if they decide to try to close down businesses again. Next slide, please. I got to say again, don't watch TV for news. If you're a business person or an investor, the worst thing you can do is watch TV and think you're educating yourself to make good business decisions. I mean, this is CNN's dream come true. It's like a hurricane every day. They top their cable news in a key demo for the first time in 19 years. Wouldn't that be bad to not be desired by and despised by people for 19 years? And then down here, they couldn't resist, even on June 8th, New York coronavirus. The New York City exits the lockdown, but enters a new crisis. You see how this works? The TV media wants to have a continuous crisis of whatever it is, and it leads to very bad business and investment decisions. In fact, people ask me, how do I stay informed? 2 ways: Wall Street Journal and talking to clients, just like you. If one of you called me or emailed me and said, "Hey, I had a question, what do you think?" I'll answer it for you, and then I'll say, what part of the business world are you in? Let me ask you a couple of questions, because I want to know. I don't care what Wolf Blitzer says about something. I want to know what you're doing in front of the clients out there. Next slide, please. This started to happen. I kind of anticipated this, but it happened even quicker than I thought. We have been in a gigantic tug of war now since probably about the 1st of April, between the fear of getting sick and the fear of losing our freedom. And I love the look on these people's faces, because this is exactly the energy and enthusiasm that the American people have for freedom. And it's sad to watch how the government kind of forced businesses to close when they didn't want to. And that has now translated into this rejection of even wearing a mask. It's like, look, I don't want you to tell me what to do. And that's what I love about America. We are a group, a nation of people that were brought here for freedom, and we love it and we will defend it. And it's just sad that somehow or other wearing a mask has been kind of transformed into an act of freedom against tyranny, which I personally don't agree with. But nice thing about that is it's America, it's a free country. If you don't agree with me, that's okay. I respect your freedom too. Next slide, please. So when people say W shape, U shape, whatever, it's going to be uneven across the board. The positives are we're going to need more warehouse space all across America to offset that just-in-time manufacturing concept where you're lean and you're mean and you have a week's worth of inventory. That works fine as long as the supply chain is working. But when the supply chain breaks down, you find out that that isn't such a hot idea. So we're bringing more warehouse space to bear so that we have some sort of buffer in case the supply chain breaks for any reason. I think we're going to have more demand for open spaces in the suburbs. That's common news now. 3 months ago, that was like a crazy statement to make. And I also feel like we have more demand for smaller towns and nearby urban metro areas. And then the fourth good thing is, for the last year and a half, I've been saying that the next time we have a recession, the Federal Reserve will lower interest rates to see to it that we can refinance our mortgages at around 2 to 2.5%. And when I said that a year ago, people's jaws were dropping. Mortgages were at 3 3/4, maybe 4%. and their jaws were dropping. But the Fed has been signaling this for a couple of years. It's like, when we have a recession, we're going to buy down interest rates and make long-term interest rates really cheap. And that's why I'm bullish on the single-family housing market. It's probably the strongest sector of the economy have right now, because that's Fed policy. They want to get mortgage rates low so that suddenly houses that weren't affordable a year ago with 3 3/4 mortgages are now a lot more affordable at 2.5. And you can see that's paying off because people are buying homes right now. The flip side of that is, here's the tough stuff. If you live in a convention city, it's going to be tough. If you live in a city that's got a major airport like Dallas, Fort Worth, there's just not going to be as many people working at the airport as there was. Or the convention centers. And of course, $40 oil prices were taking a toll on the oil business in 2019, and it's still taking a toll in 2020. There's going to be an enormous amount of consolidation in the energy business going forward. And so there are going to be a lot of bankruptcies, a lot of consolidations. And so if you live and invest in these states that I'm listing there, you're going to have to take that into account. The risk also was that some companies aren't going to get government handouts for some reason. It looks like the government's done a pretty good job. They basically gave everybody a handout with the PPP loans. And my guess is they're going to bail out, they're going to send out some more of those checks pretty soon. But the rest of these, movie theaters, restaurants, casinos, vacation destinations, sports events, and concerts, you can see it here. And also every city and state in the country is under budget duress. So, you know, when you look at a place like San Antonio, for example, a lot of hotel business, a lot of convention business, a lot of sports business, a lot of vacation business, city and state government, there is just an illustration of a town that's going to get hit hard in a lot of different ways. And they're not unique. I'm just using them as an illustration. Next slide, please. Small business confidence. This is the National Federation of Independent Businesses. I'm guessing some of the people on this call are a member of that organization. And the number of people, percent of people say we're going to hire people in the next 3 months went virtually to 0 in March and April, and it kicked up a little bit, and that's good. What we have to be careful of, I am optimistic. There's no question about it. I will be optimistic no matter how bad the news is, because I know the American people are entrepreneurial and have a government that supports small business. But the headline might show here that, wow, looky there, small business confidence rose 28% last month. They don't show you the historical perspective here that, yeah, but it's still way below where it was. Next slide, please. Come about March 17th and 18th, our bond market collapsed just as bad or worse than it did in 2008. I didn't see it coming. I didn't feel it. I felt it coming in 08. I knew Fannie Mae and Freddie Mac were in big trouble a year before things blew up, but this time caught me totally off guard. But the Federal Reserve went in and decided, you know what, we have to create a facility. That's a nice word for a bailout. Treasury market, mortgages, high-grade corporate, municipal bonds, junk bonds, AAA-rated CLO tranches. Basically, the Fed has stepped in and said, we're going to create a market for everything. Next slide, please. And just so you have a feeling about the severity of this financial crisis, it's so funny how they reflect back now and say, is this like the 2008 financial crisis? Well, actually, this is bigger than that. What these two charts show, the top chart shows the amount of Treasury securities that the Fed purchases, and the one below it is the amount that they purchase of mortgage securities. This is how the Fed engineers a 2.5% mortgage rate. They buy 10-year treasuries and they buy 30-year mortgages, and they buy and buy and buy and overpay and overpay and overpay until the mortgage rate gets down to 2.5 or maybe lower. We'll see. But look at the magnitude of this. You see that vertical gray bar close to the middle there, that's around 2008. That was the financial crisis. And right in there from 2009 to 2012, you see the Fed went in and bought $1.5 trillion worth of bonds. Look at the scope of what they've done here this year so far. It's just gone off the chart. 1.6 trillion in treasury bonds increase, and a $500 billion increase in mortgages. There's no mystery why the mortgage rate now is about 2.7%. In fact, currently the mortgage rate should be around 2.3%, but there's too much business in the mortgage market right now, and they don't have to get it that low yet. Next slide, please. This one's pretty good too. You think the Fed doesn't hit the panic button? This is how many bonds that they buy on a weekly basis. And see that big blip in there in that gray bar of October 1st, 2008? That was at the peak of the financial disturbance. The Fed bought 292 billion in bonds and securities in 1 week. How does that compare with March 25th when they bought 568 billion? You see what I'm saying? This was a big deal. Just like the talking head said, this ain't no party. This ain't no disco. This ain't no fooling around. That's why the credit markets have evened out, because the Fed has promised to buy everything. And that's another reason why the stock market has gone higher too. Next slide, please. This is what the Fed is trying to prevent, what I call a debt jubilee, which is a global bankruptcy of everybody, individuals, businesses, governments. And so if you go to the next slide, please, Jennifer. Here's the situation. Individuals have too much debt, so do businesses, and so do government. And the Treasury and the Fed's determined never let this happen. I don't care if they have to print $20 trillion. They will do it if they have to. Next slide, please. What happens is when everybody's in debt heavily, including governments, when you have a recession, if you're a city government and all of a sudden your retail sales taxes are down by 30, 40%, you're in trouble and you can't pay back your debt or anything else. And so the government response has been, let's lower interest rates so you can borrow even more. And then let's make you loans when nobody else wants to make you a loan. And if we need to, we'll print money and give it to you so you won't default. That's the PPP. That's the new one this time. It's a grant. It's a forgivable loan. That's a nuance. That's a new tool. That's a new medicine to give businesses money and then knowing that it will be forgiven. And I totally understand it. I'm just giving you context here because some of you might say, well, interest rates can't stay this low forever, or the government surely can't borrow more money. They can't print another 3 trillion for a CARES 4 and 5 Act. My answer is, you bet they can. And they can go way higher than 3 or 4 trillion. And keep in mind, if you never heard me speak before, I'm an economist. That means there's a 50% chance anything I say is wrong. But EO could have paid $500,000 for Ben Bernanke or Janet Yellen or Alan Greenspan, and their odds of being accurate aren't any higher than mine, and they would admit that. Next slide, please. And this is why they can't let it happen. When they see the stock market start to collapse, they get nervous, they get scared. The Dow is down less than 1,000 points about a month ago, and Jay Powell came out and just made a real innocuous statement. It's like, not only are we going to buy a lot of bonds through ETFs, we're going to buy individual bonds, which is a meaningless statement. But what it did, the stock market stopped its decline and now has moved back up toward record highs again. They are definitely trying to manage the stock market because they can't let this global bankruptcy happen. Next slide. Here's what we have to watch out for as investors. What happens when the medicine stops working? And what I mean by that is monetary policy has a declining utility. By that, I mean, the first time you print $1 trillion, you get a big bang for your buck. The second time you do it, you still get a big bang, but not quite. The third time, it's less. The fourth time, it's less. Somewhere out there, fifth time, sixth, seventh, whatever it is, not only do you get a bang for your buck, but it goes negative. And so here's what I'm looking for. I don't see this happening, but I know a lot of my clients are worried about it. And I'm going to show you in a minute one chart that you just need to follow if you're concerned about this. But here's what happens when the medicine stops working. For example, right now, in the next month or so, I expect the new CARES Act will come out, and it'll be $1 trillion, or it'll be $2 trillion, or whatever it'll be. And the stock market better go up. Because if they announce we're going to print another $2 trillion and the stock market falls and the value of the dollar falls and people no longer want to own dollars and gold and Bitcoin skyrocket, then people start withdrawing their savings to buy hard assets, which would be largely real estate, and muscle cars for that matter. That's not a bad one to own either. And money flows out of America to other countries. This is what you're worrying about. When people say, what happens if printing all this money blows up and America is no longer the reserve currency, this is what they're asking me is, when will this sequence of events happen? And my answer to that is not for quite a while. And let's go to the next slide. This comes right out of the Federal Reserve Bank of St. Louis. Easy to get, it's free. If you're worried about this, follow this chart. Because what will happen is, when the medicine runs out, suddenly the Federal Reserve will not be capable. They won't have any tools to do any work. Their medicine doesn't work against the current environment. And right now you can see it is. As long as the US dollar is strong, that means money from all over the earth is still flowing into the United States. And it's not going into gold, and it's not going into Bitcoin, and it's not going to India or China or the International Monetary Fund. My hypothesis is, and I've said this before at your meeting probably 2 years ago, so I won't belabor it, but people say the US debt is 100% of our economy. They'll say US debt's 100% of GDP, and that's a big number. Well, of course it is, but Japan is my canary in the coal mine. Their debt to GDP is 200%. Double ours. Do they have any inflation? No, they can't buy a piece of inflation. Is their currency strong? It's stronger than it's ever been before. And so my take is, if Japan is 200% debt to GDP, what that means is the US debt, which is now at probably 27 trillion, could go to 44 trillion, and we'd still be just like Japan, who has a strong currency and no inflation. So I hope that gives you a little context. And this is why I think interest rates are going to stay low for a long time. Next slide, please. I wanted to refresh my memory, because when we put interest rates down to zero, this is the Fed funds rate, and you can see how it's, we put it down to zero in 2009, and I didn't remember, I had to refresh my memory, 7 years. And this financial crisis was way bigger than what happened in 2008. And so if they kept the interest rate on the Fed funds at zero for 7 years, I would expect nothing different this time around. And so the only thing different this time is they may decide not only to peg the short-term Fed funds rate, but they're talking seriously about pegging the 10-year Treasury. And what that means is, we will not, as a Federal Reserve, we will not allow the 10-year Treasury to go above 1% or 0.5%, whatever they decide. And you say, well, how do you do that? Who would buy a Treasury at 0.5%? The answer is, they don't care if you buy any of them. They can print $2 quadrillion and buy every Treasury bond that's printed at a yield of 0.5%, and then you decide, do you want any of them or not? And they don't care if you want them or not. Next slide, please. So the bottom line is, for a business person, interest rates are going to stay low for a long time. And sometimes people approach me and say, hey, I'm typically borrowing long-term. I'm thinking about, typically borrowing short-term, but I'm thinking about getting a long-term loan. I'm thinking about locking in right now. Well, that makes some sense at certain stages of the game, but right now, I don't see any hazard to borrowing short, because I don't see interest rates going up for a long period of time. And then this issue, it's like when the Fed gets desperate enough, they're printing money to buy bonds, and that's what's making bond prices go up. And then the next question is, what would they do? Why wouldn't they just print money and buy stock? If they get worried and the Dow falls 15,000 points because of some bad news, why wouldn't they just print money and buy stock? And you say, well, that's a joke. And it's an ugly joke. And the fact of the matter is, I would ask this, surely they're not stupid enough to print money and buy stock. Well, guess what? They are. Janet Yellen used to be chairman of the Fed. She and Bernanke just testified to Congress a couple of days ago. I need to find out if they suggested this again, but this was just a couple months ago. Janet Yellen says the Fed doesn't need to buy equities now, but Congress should reconsider allowing it. This is outrageous. The bond market is no longer an indicator of economic activity. When I see the interest rate on the 10-year Treasury go up or down for the last 30 years, I would say, oh, that means the economy's picking up or it's slowing down. It has nothing to do with that now because the bond market has been completely taken over by the Fed, and they're controlling the 10-year interest rate as well as the one-day interest rate. And I just want to call your attention to this, the Bank of Japan, that note down at the bottom, the BOJ, Bank of Japan, they've been printing money and buying stocks since 2013, and now they own 80% of the ETFs in the Nikkei. So when I see that the Nikkei is up 12%, that means nothing about Japan at all because the government is buying it. And I think China's doing the same thing right now. So the stock market is no indication whatsoever of economic activity, including ours. Next slide, please. Here, people say, wow, the stock market's sure given a different take than the bond market or the business conditions. And I was joking at the time, it's like, look, when sports shut down, you got all these people at home with nothing to do, and they've been playing video games so much that they're sick of it, and there's no sports betting available. So what do? All of a sudden, you open up a new account at Robinhood and find out that day trading stocks is a lot more energetic than playing a video game with 3 of your buddies. And I think sports betting will be a draw. If we get basketball and football and baseball and even golf or whatever else you can bet on, I could see some of this some of this energy in the stock market start to dissipate. But for now, and I just use this as an example, here's Chesapeake, which just took bankruptcy. Most people knew it was on the way to bankruptcy, but just within, what was that? January. Oh yeah, I've got it there. In January, it was $192 a share. By May, it dropped to $7 a share because people knew it was going to bankruptcy. And then here come the day traders in, move it up to $12.50 on June 4th, and move it up to $25 on June 5th, and move it up to $77 on June 8th. You see what I'm saying? The stock market is not an indicator of anything either. I will say this. I just heard this morning that 5 or 6 stocks now make up 22% of the S&P 500. Those 6 stocks are doing well because those companies are doing well. But let's see, 500 minus 6, that would be 494. The rest of them are down. So if you want to know the signal the stock market is sending, look at what the stock market performance is minus those 6 stocks. And that's the signal out of the market. And the market is saying, this is a tough time for businesses right now. Next slide, please. As an investor, as a business owner, this is a good thing. As an investor, it's a scary thing. There's a new bankruptcy chapter. I'm not an expert on bankruptcy. Fortunately, I've never had to do that, but I'm familiar with Chapter 7, and I'm familiar with Chapter 11 and Chapter 13. One of them, you just liquidate everything, sell it all, and walk away. The other is you reorganize. You tell your bondholders, I'm not paying you. Cut the bonds, cut your debt by 60% or 70%. Get rid of all your shareholders, and the new bondholders are the new owners of the company. Chapter 5 is a new one. That was just created a couple of months ago. I just found out about it a couple of days ago. Chapter 5 is a reorganization for smaller companies, and it's quicker and cheaper to do, and there's not as much legal hassle and not as much proof. And so the government is clearing the pathway for, remember that debt jubilee, that grass fire I was showing you back there, how the Congress is trying to avoid that happening? Well, it's really interesting because they're using the PPP and these other funds to keep people from laying off workers. And at the same time, they're revising the bankruptcy code to make it easier to file for bankruptcy, because bankruptcy is actually a good thing for the economy. Because what happens is, if you're a business and you borrow too much money and you can't pay it back, you're dead. And a government willing to loan you money with 0 interest for another 6 months, all that means is you died 6 months ago and now you're going to die as soon as that is gone. You're called a zombie business. But when you file for bankruptcy, your debt load is reduced. You renegotiate all the leases on your bricks and mortar places, and suddenly you're a viable firm again, and you stay in business, and you keep a lot of your employees and the economic activity that goes with that. So as an investor, this is pretty scary, because if you own a small shopping center in Houston, for example, and it's full of small businesses, well, you're looking at this, and all of a sudden, every tenant you got in your building is being kind of incentivized to file for bankruptcy. And that's when things happen. When a tenant files for bankruptcy, suddenly the landlord's not receiving any money. And so that tail is wagging right now, and the repercussions of that look pretty serious to me as an investor. Next slide, please. It's funny, before I talk about this good news, I hope you can sense the bifurcation in my feeling, because really the US economy needs a big bankruptcy wave to go through. And at the same token, as an investor, you're in risk of losing all your money if you're a stockholder, and maybe 40 to 60% of your money if you're a bondholder. So that's the mixed emotions I have with what's going on here. I wanted to share this good news with you because I've been doing quite a bit of reading about demographics for the last year and a half. And I want to explain a couple of things to you. You might have read it. Let me look up here, Matt. The book, Harry S. Dent Jr., The Demographic Cliff. If you haven't read this book, I would really recommend it. In fact, also another book that I read recently that I found quite valuable is written by George Friedman, and it's called The Calm Before the Storm. I think if you read those two books, you're going to have a pretty clear understanding of you know that picture I had of the volcano and the smoke, and you can't get your hands on it and you can't see through it? Those two books I just mentioned helped me get my hands around that and make some sense of it, with the idea of how to make decisions going forward. Here's the good news that I see coming out of demographics. We're all familiar with this baby boom that was so big, followed up by a baby bust that was pretty small, followed up by the echo boom, which were just the children of the baby boomers. And then we got this new one out there, I guess we call them millennials, if you will. They're a big group too, but right now they're young enough. I don't need to talk about them because, well, I just don't. So with that said, these are the number of births. You can see that. And so let's go to the next slide, Jennifer. The biggest chunk of the baby boomers are now around 65 years old, and there's a lot of them. The dearth is down there in the 45-year-olds. There's not very many of them. The echo boom folks are now 30 years old, and there's a lot of them again. Not quite as many as the boomers, but a lot of them. And so let's go to the next slide. This is what Dent did that I really thought was super cool. He combined the demographics with spending habits of the American people. And this just puts it all together for me. People have been asking, you know, how come we had a jobless recession after the dot-com bust? How come 2002 we were still coming out of a recession? How come we didn't get job growth all through the 2000s? How come we had a jobless recovery after 2008 up until 2016? How come? How come? This chart right here explains the whole thing to me. 65-year-olds. This is the biggest group of people in America. What do? They retire at 63. Their net worth is the highest it'll reach by age 64. Their purchases and consumption of vacation homes peaks at age 65. Their consumption of cruise ship services peaks at age 70. Their consumption of medicine peaks at age 77. And then out there around age 83, their consumption of nursing homes hits a peak. So as you can see in the background behind that yellow box, all of those people are at 65. And over the last several years, let's go to the next slide and I'll start from there. So look down here at the baby bust era, the low spot of this cycle of Americans, period, being born. They're now 45 years old. What are they doing? They hit their maximum spending at age 86. Then they start saving money for the next 8 years and reach a peak in savings at age 54 and then retire at age 63 and hit maximum net worth. So you see what's happening? The people in America that are in their peak spending years right now has been declining for a decade or more. And now it's at absolute bottom because the fewest people born in a long, long time are now 45 years old. And that is your home run hitter. That's your number 4 cleanup batter, the 46-year-old. And right now there just aren't very many of them. And that's why, in my mind, our economy has been somewhat sluggish and why interest rates have been so low for 20 years now. Next slide, please. Then let's look at the next big bump that's coming up, and that's coming to a theater near all of us every year for quite a while now, at least for the next 15 to 20 years, because now that peak is 30 years old. And what are they doing? Well, on average, you're age 29 when you have your first child. On average, you're age 31 when you buy your first home. And somewhere between 37 and 41, you buy your largest house. And all the furniture and all that. And of course, then by age 46, you're at your peak spending years. So what I see going forward is a decade or maybe even 15 years or so of just growth in the number of people that are approaching their peak spending years. And they will replace the baby boomers who have gone past that peak in spending. So with that thought in mind, to me, I see the next 20 years being a lot stronger economically than the last 20 years for this very reason. And I'm not even talking about the millennials. I know if you're a college president, or if you're in student housing, or if you're in apartments, I know you're looking at that big peak coming up after that. But for right now, I'm not going to discuss that one today. Next slide, please. So the risk to my outlook is that our economy is going to start growing again, but at a pretty slow pace. We had a jobless recovery after 9/11. We had a jobless recovery after 2008. I don't know why now would be any different, because those baby boomers are still out there in big ways, and the baby bust generation at peak spending is just too small. So the risk to the outlook for me of a slow recovery with very low interest rates going forward is that the virus comes back next winter. Well, I'm not sure it's even going to go away this year. I was stupid enough to think maybe the summer might help, but that's not the case. I guess what we're going to have to ask is, at this point, the second issue, will government have the audacity to force businesses to close again, to force business owners to lose the jobs, the business they created, their life goals, to just lose it? I can't fathom the United States of America forcing that to happen to anybody. Maybe the mortgage market doesn't regain normalcy. It has. That's good. What if the helicopter money isn't enough? The $1,200 was definitely not enough. I figured, okay, $2 trillion, really, I think the government, if they're going to try to bridge us out of this, it's going to be about 2 or 3 trillion every quarter. So we tried 2 to 3 trillion back in April or so, and we're going to try another something here in the next month, I bet. But if it's not 2 or 3 trillion, it's probably not going to be enough. Many companies are going to file for bankruptcy or close. That's happening, and that's going to continue to happen. So you just have to figure that into your business plans. 2 things I want to consider too, for me personally and for you to consider, is what will income tax rates look like in 2021? I'm trying to make some decisions about, do I take income in 2020 or do I defer it and waltz into 2021? I can't say at this point, but my guess is income taxes will be higher going forward over the next 5 years anyhow. And then this other issue, remember what I said, what happens if the Fed announces something and it doesn't work? Well, there's another way to look at that is, what if after the presidential election, we get a new Secretary of the Treasury who can't stand banks or the Federal Reserve and says, we're going to redo the charter on the Fed. And that charter change will mean that the Fed will not bail out large banks going forward. We will let large banks fail, just like every other Main Street business. If that happens, all heck breaks loose. Because right now, the stock market and the bond market are all propped up by the thought that the Federal Reserve can print unlimited money to buy bonds and maybe even buy stocks. So when I start seeing people's suggestions about who might be the vice president next year or who might be named Secretary of Treasury next year, just keep in mind, it's a free country. I can't stand Democrats or Republicans. I think both tribal parties are a blight to our economic future, and their tribal politics is just repugnant to me. And so I don't intend to vote for either one of them again. I'll vote for Gary, just like I did 4 years ago, even though I don't know Gary. But I found out he's from Albuquerque, New Mexico, because when I told them about a year ago I voted for Gary, I got a standing ovation, and I had no idea what was happening, and I didn't know it, but Gary was from Albuquerque. So that's all I know about Gary. But what I know about Republicans and Democrats is enough that I don't want to be caught supporting this kind of tribal politics. By that, I mean, I don't care if I don't win, you're not going to win. And I don't care if our country suffers mightily for it, because my job is to be sure you don't win at all costs. That's not working for me. Next slide, please. Just to give you some history on taxes, this is the top end marginal tax rate, top end for marginal income taxes, going back to when it was created in 1913. You ever hear anybody say, don't let a government put a new tax on you, because once you let them in the door, they'll just barge in? Well, that comes from 1913, when the income tax rate started out at 7% for 3 years, and 3 years later it was 77%. This is why people are afraid of their government. You don't want to give your government any power, because they know how to use it in a way that usually doesn't bode well for individuals. And then I feel like this is similar to World War II for me. And so as we got into World War II, we couldn't pay for all of those planes and all those soldiers. The government did have the revenue. So the marginal tax rate rose back up to 70%, and then up to 94% at a peak. This is how our government has paid its bills in the past. And as you can see, I wanted to call your attention to the fact that the top marginal tax rate stayed above 70% for 44 years until Reagan came along and cut them down. And so in my mind, we can't afford to run $10 trillion deficits a year. We could run $1 trillion for a long time, but we can't run $5 to $10 trillion deficits for very long. And taxes are going to go up. I just feel like it's almost a certainty. And cities are going to try to raise property taxes. They're going to try to raise taxes any way they possibly can, because their revenue is damaged so badly right now. Next slide, please. Sometimes hosts will ask me, Mark, do you have any final comments? And I made this one, and I finally decided to put it in. Here's why I'm optimistic. Just like after 9/11, we were afraid of terrorism and that people wouldn't travel and they didn't want to get out much. And I started doing speeches about 10 days after that happened. And people are asking me, how will we ever get out of this? And I fell back on this deal. Americans do not tolerate deferred gratification. And it's just like the freedom, the tug of freedom against fear, exactly the same thing. And in 2001, I said, we'll either conquer terrorism or we'll get used to it, because we don't hide in home in fear for very long. And all you got to do is change the word terrorism to virus, and you get the same premise. The American people are we're either going to solve it with a vaccine, or people are going to say, you know what, I don't care anymore. I'm going to do things. And if you're old and you need to be worried about it, then stay home. But we're not going to ruin our entire economy just so people that have asthma cannot get sick. I totally understand that. So anyhow, in the long run, I'm betting on American people. I'm betting on their unwillingness to tolerate deferred gratification. As you can see, it's happening already. So with that said, Jennifer, that's the end of my remarks I've prepared. If you'd like to open it up for questions, I'd be happy to do my best.
Let's see. If you have any questions, if you'll type them into the chat feature. And
While they're at it, one of the questions that I've been getting a lot is about forbearance for apartments and for mortgages. And it's really hard to imagine what's happening here, where it's a chain of events that's unfolding, where the government came out and said, it's okay if you say you're affected by coronavirus, you don't have to make your mortgage payments anymore. And then businesses have kind of come out and said, I'm sorry, but we're not paying our rent anymore. So our government response at this point is to print money and give it to businesses with the understanding that you can't really fire your workers. Oh, and by the way, we gave you some extra money in there to pay your rent too. So what you can see is the government is trying to print money and give it away to keep people from filing bankruptcy, firing people, and stop making lease payments. Because here's what I can't quite see through the haze yet. I wish I could. But so what happens to the mortgage market if a third of the mortgages in America stop making their payments? I don't know the answer to that, honestly. It's never happened before. And so that's sitting out there right now. And then my other question is, what's going to happen to all the small real estate investors that own a little strip shopping center that's got a nail salon in it and maybe a dollar store I forgot I got the nail salon. But anyhow, what's going to happen to all those small real estate investors that own a little shopping center or own a small apartment complex or own a 2 to 10 or 12 single family homes or a little apartment when the government says it's okay for you to not make your payments anymore? And the answer is, if you're big enough, you can go to the government and they'll bail you out. I guarantee you, if BlackRock or Blackstone, whichever one it is, I can't ever keep it separate. I guarantee you, if all of their bond investments stop paying, or if the real estate that they own stop paying, I'm guessing they go to the government, they get a gigantic bridge loan directly from the Fed somewhere. But a little guy like me, or some of you in this audience here, you own a little shopping center, you bought it for $800,000, you owe $500 against it, and your tenants stop paying, I think you're dead in the water. So this is yet to be determined, but it's something that I'm trying to make sense of, and I think as investors and business people, you have to be aware of that and the circumstances involved.
Okay, Mark, we've had several questions come in. Where would you invest right now?
Well, I used to have 77% of my whole retirement account in TIA Crefts commercial real estate account. Now it's zero on that. I don't think commercial real estate values are going to collapse. I just don't think they're going to go up. They might drop a little bit, maybe 10%, maybe 15%. I think that's possible, but then they'll go up again because investor demand is going to be insatiable for real estate going forward. But I don't own real estate anymore. 95% of my entire retirement account right now is either in CDs that are earning 3% or in TIA Crefts traditional account, which is earning 3%. And that's about it for now. I'm all cash basically, because I can't see. When I'm looking through the smoke of that volcano, I don't want to gamble. I don't gamble on sports, and I don't want to gamble on stocks. I'll make it through to another day, and I'm waiting for that day to happen and looking forward to it.
We have a question specifically about Tesla. Are we crazy not to own Tesla stock right now?
It's a great sports game. It's a great video game. It's better than sports betting. I mean, I wouldn't own it for a minute, but you know, people have made a lot of money on it. And if you like to gamble, gamble some. It's fun. Put $50 on red number 2, and once in a while, red number 2 comes up, and sometimes red number 2 can happen several times. And so I think it's a sign of a bubble. It's a sign of a government printing too much money. Normally, people would say, Mark, this printing all this money is going to create inflation, isn't it? And the answer is, all this money we printed over the last 20 years hasn't created a lick of inflation. It hasn't made TV sets get more expensive. What it has done is inflate investable assets, the prices of houses, the price of commercial real estate, the price of bonds, and the price of stocks are all in somewhat of a bubble fueled by multiple trillions of dollars printed by the US government.
A question regarding home values. What might we see with home values?
That depends on the price range, I think, because before the virus happened, even as late as February, the housing market was on fire again. It was the strongest sector of the US economy, and it is today. Now, with that said, within the housing sector, let's break the housing market into 3 components. The bottom third of the price range, the middle third, and the top third. The bottom third has way excess demand and not enough supply. And I feel like prices of those are going to continue to go up. That's part of the reason we get mortgage rates down to 2.5%. So suddenly a house that wasn't affordable at 3 3/4 is affordable again at 2.5. The top end of the market has been sluggish for about 3 or 4 years. I don't know why. I went all over the country. I speak all the time. I do this 50 times a year. And I have the chief economist of this and that speaking in front of me or after me. I hear them. I ask them questions. What happened to the top third of the housing market? Why aren't rich people buying houses? And nobody in this country had the answer to that. And that was before the tax reform that limited how much interest and tax deduction you can write off. So what I'm getting at is, I think the top third of the market will continue to be soft because it was earlier. The middle third of the market, price range wise, in Houston, I don't know what that might be. Let's say it's 350 to 600,000. That middle part of the market's really murky to me. I haven't feel for that. It's kind of there, and houses are selling. So if there's any price pressure, I would say the price pressure will be higher for higher prices in the bottom third of the market, maybe pretty much unchanged in the middle. And you might see a situation where the top end of the market, $1 million house might sell for 950, 920,000, or a 1.5 million myself for 1.15. I could see that kind of situation happening because frankly, I'm not sure people want to own big, expensive houses anymore. The baby boomers, we thought that was cool, I guess. Conspicuous consumption, we didn't coin that phrase, but we've modeled it pretty good. And conspicuous consumption means you buy a big, gigantic house so people think you're pretty successful. And that works for a baby boomer that's now 70 years old. But for another person that's maybe in the same job, maybe it's a cardiologist baby boomer thought that'd be fun to have a 10,000 square foot house. The same cardiologist that's now 38 years old isn't making the same money after Medicare got done with him. And not only not making the same money, couldn't afford it, but also I think he or she might say, I could never buy this gigantic house. My friends would just hate me. My friends would say, you are eating up the environment. This house is whatever the opposite of carbon neutral is, this is carbon unneutral. And I don't like your house. I don't like what you're doing to the planet. And now I don't like you. I will never come to your house. So I'm just afraid that the demographic changes are going to have a negative impact on big, expensive houses all over the country.
Mark, I know you need to hop off here soon, but do you have time for one more question?
Absolutely.
What impact does foreign countries like China holding large amounts of our national debt have, especially if we have a market crash?
Oh man, I'm so glad they asked that, because what I've said for the last 6 years probably is you have to keep in mind that China is a subcontractor for America. If we don't buy stuff from them, they're dead. I mentioned 5 years ago, if we wanted to send a message to China, all we got to do is have a buyer strike for a week. Just say, don't buy anything for a week. If it says made in China, don't buy it. It would take about 40 seconds for the email to go from Walmart and Target to Shanghai or wherever the factory is, Hangzhou. Take about 40 seconds for that email to get to China, to the supplier, manufacturer, and the manufacturer would take another 40 seconds for that person to notify all the workers, don't come in for the next 10 days because we're not shipping anything. And the whole country their economy would come to a screeching halt. And our only message would be look, you people of China, we love you. We value you as a human being, but your communist dictatorship isn't working for us, and you guys need to start buying some stuff from us. We want you to be a trade partner. We don't want you stealing our intellectual property. A trade partner means you get jobs and wealth and we get jobs and wealth, and that's not how it's working here. China does not own enough bonds to matter. The net worth of the American people is $113 trillion, and the bond holdings of China is $1 trillion. If I was president for a week before I got impeached, I would have a buyer strike for a week, and then I would say, let's come up with $1 trillion and let China sell all their bonds to us. It'd be over. It's not an issue. I want to work with China. I love Chinese people. I have them in my house all the time. The students taught my wife and I how to play mahjong. It's super fun. And they laughed as we tried to do the Chinese names and numbers for the tiles. But the fact of the matter is, they need to be a trading partner for us, and the threat of their bonds is nothing.
Okay, with that, there's a few more questions that we didn't get to, and Mark, I'll email those over to you later, and if you've got time this afternoon, maybe you can look at those and I'll send those out to everyone. But I want to thank you for taking the time to talk to us today, and thank you all for joining.
Thank you. Have a good day.
Okay, you too. Thank you.